Hey everyone, thanks for stopping in here to my channel, Modern Money Method. And I wanted to make just a short video here to talk about why soon you are going to be hearing a lot of headlines about lending institutions, maybe some financial institutions as well, but mostly ones that are very tied to lending. And especially mortgages, but it will be across all gamuts, even car loans and things of that sort. And that they are going to start having layoffs and imploding and closing. We've already had a few that have closed. They haven't really made the headlines, but I'm going to give you a quick tutorial on why this would happen. And this is a video that actually you probably want to see my graphs. I know a lot of times I make the graphs and then I verbally explain them, but this is one that'll probably take some visual acuity to see what's going on. So what I have pulled up here is a chart that it's not 100% accurate, but it's the 30-year fixed rate mortgage average in the United States, and it's across all states. They take a group average, have the major companies report to them. So, but they only do it like 1 day a week. So, and interest rates vary greatly all the time. Just this last week, we bumped our heads up against 6.25 twice, which that's for the A borrower, 750 credit score, 20% down. You start getting into someone in the 600s or less than 20% down, and you're talking about interest rates now for those borrowers, the non-top tier borrowers, are at 6.5, 6.75, and even worse. This is a chart just of the last year for mortgage interest rates. And is this amazing or what? You go back here just to last September, and it was 2.86, under 3%. And when Federal Reserve Chairman Powell announced last fall that they were going to start upping the federal funds rate, that is why I got on panic mode. I started calling everyone who needed to refi or buy, and while the rates were still there in the low threes. And that's why you also saw the housing price boom and crunch occur, because rates had been bouncing along at these levels for a couple years, and they started creeping up right here in the beginning of the year, January, February, and people started feeling nervous that, hey, if I wait much longer, I don't know what's going to happen, right? And so we had rates of 3.5 in January, and by the time we got right here to February, we were almost at 4%, and I knew, oh boy, things are not going to be good. And what I'm going to teach you today, though, is how the lending institutions, they don't just sit there with piles of cash in a room and obviously hand it out. What they have is they have lines of credit with major banks that then fund these lending companies. There's hundreds of them. There's a few dozen major players that employ thousands of people, and then there's lots of smaller ones. So mostly private mortgage companies make the majority of the lending in America, not actual banks. And since they work off a line of credits, they make a loan, and then when they close, the loan actually is with them for a few weeks, possibly up to a month, until they package it with a group of other loans, and then they sell those interest products out on the open market. And there's a market for them, and there's a known, I'm only going to talk about A borrowers, 20% down, 80% loan to value on their house or less. And that's the loans we're going to talk about. But there's all kinds of tiers that get packaged. All kinds of companies, municipalities, when they have money, or pension funds, they buy these mortgages to get the income stream. So a lot of people think it's a bad, negative thing that's going on, that people are buying and selling debt. But it's a very necessary thing, because there's large companies with cash, and instead of just sitting on that cash and earning zero or close to zero in the bank, if they know they're not going to need a percentage of it for 1 year, 2 years, 3 years, they can buy mortgage products. So as you can see, we had a shoot up in rates here in January and February. real shock to the system. Homes, mortgage payments started costing 20-30% more just in a couple months. And then we stalled out for a month, a little bit of a breather. And then we had another leg up, and we got all the way up into the low fives here. And this was in April and May. Now we had mortgage payments that were running 30-40% more than just a few months earlier. And then we even came back, and this was in late May and early June, and we had some rates that were being that we could offer in the mid fours, close to some people in the mid fours. So things were looking calm again, and then all of a sudden we had a crazy shoot up to where rates almost went to, I think they did go to 6% in here. So this is kind of a smoothing out of what you're seeing here, because this is showing 1 year. And then they came down from that point all the way and dipped back below 5% just for a couple days at the very beginning of August. We saw some 4.875s and such. And then since then, this was, in my opinion, this is one of the bigger shockers. From right here, in 1 month, just a tad over a month, we went up a whole percent right here. And you can look over here and say that occurred too, but this percent from December to February, that was almost 2 months, okay? And you'll go, well, what's 2 months versus 1 month? And I'm going to show you why. Because in here, you have time to close the loans and sell them on the street. And if this line is going up, if prevailing interest rates on mortgages or any type of debt is going up, the value of the loan that you made over here is worth less, right? If you made a loan over here at 3%, so let's say it's $1 million loan, so it's got $30,000 a year in interest stream. Somebody might just want to buy that. They want to buy $30,000 a year of interest income. So they would pay you $1 million. Well, when that loan right here gets to 3.5, they don't have to pay you $1 million anymore. They can go look for a $850,000 loan that'll give them a $30,000 income stream. They don't have to give up their whole $1 million. So your $1 million loan is not worth $1 million down here when rates are up here. So, and I'll explain this more. So, and then this move here from 4, let's call it, to 5, that took another 2 months. So they had time to make the loans and sell them halfway up. Still some pain, but not as crazy as having rates go up 1% in a month. And these movements are insane. In the past, generally, interest rates don't move by more than 1% in a whole year, let alone these 1% and 2% moves in 2 months. So, and then if a lender made a loan here in the mid 5s and then put it up for sale on open market here, it actually had gone up in value. So lenders had a breather right here where they were making loans and then actually selling them for a slight profit. And then they got spanked again. This was a really short, and now this seems more interesting because this short of a move is not as bad because it only had 2 weeks. So you were already higher, okay? And then you came down. So you originated some loans here and then you were selling them over here. And these, it was only a week or two of loans. You didn't create them for a long period of time and then sold them at this. Possibly even sold them here. So you have to think they sell them 30 to 60 days after closing them. So, and from when the rates are low, someone generally buys and locks in, that takes 30 days. So that is why we have a ticking time bomb on our hands now, because lenders were making loans here in the 5.5 range, and then rates dropped down in the 5s, and we had massive volume. There was a lot of people sitting on the sidelines waiting for rates in here. We did a lot of loans in the low 5s, high 4s, tons of volume, and those have now closed in the last few weeks. So the lenders made loans, let's say at 5%, and now they're having to sell these on the open market, but the prevailing rate is 6. And I'm going to show you how this financially is going to crush a lot of companies. They have got to be just bleeding dollars and wondering how they're going to get out of this. So we hop over here to a little chart that I made, and it's called Why Lending Institutions Will Soon Implode. And those that'll be hurt the most are ones that made the majority of their loans at the 5% range, either the first week of August there or about 45 days before that. when rates were at 5. Let's hop back over here and see where there is right here in June. So I guess it was in June we had this little range where it was low 5s, then rallied up. Because there is a chance maybe they didn't sell these. Maybe they're like, man, we can't sell these, we're going to lose money. And they waited and came back over here and sold. Maybe they even waited, we're hoping to make money if rates went further down. It's a little bit of a game. But so if a mortgage company makes a $500,000 loan, this is a line of credit from a company that it's a rotating 60, 90-day line of credit. So they make this loan and then they've got to sell it on the street, the lending institution, whoever does your loan. And I'm not going to say any names here, but just all the big companies, even the ones that are internet companies, regional companies. I mean, most of the companies I work for have a few thousand employees. That loan, if interest rates, if they make a 5% rate loan and rates are 5%, when they go to sell this, after they've collected all the paperwork, got the final stuff, and they're packaging it with some others, because generally they sell these in groups of 10 million or 50 million. And so the dollar amounts over here are not all 500,000, but they package them together to make a round number. That loan has a value of 515,000, and you'd be like, well, why? And the reason is because all of the hard work was already done to generate this loan, and generally some fees were collected and things of that sort. And these people know that they're going to get this income stream, most likely not for 30 years. Generally, the average mortgage lasts about 5 to 7 years. So let's just go with 6 years. So they know they're going to collect $25,000 worth of interest on this loan for 6 years, so $150,000. So they pay a slight premium to collect that. So the mortgage company makes $15,000 for doing this loan, and then that goes back to pay all the salaries and pay all the overhead and all of those things. Okay. Now, if they happen to make a 4.5% loan, let's say a month earlier, okay, and they're delivering that now when rates are at 5%, I want to show you something. That loan is only worth $485,000, and the reason being is it is going to collect a significantly less amount of interest. Instead of what we said, the other one was going to be $150,000 worth of interest, right? This one is only going to be $22,500 a year. This is only going to be $135,000 worth of interest. So they pay less money for that because they're not going to collect the whole $150,000. And I just wanted to show one other example. Let's say possibly they made a loan right here. Let's say they got 6% from somebody, and then by the time they closed it up and packaged the loan, they were selling it at that August 4th low. So this is a game where they don't always lose money. They could have made a loan at 6%, and then they're selling it on the street for $575,000 because this loan is going to generate an extra amount of money over the life of this loan. And what I want to show you here is, though, why this most latest news move is shocking and going to be devastating. Because, like I said, this one here was kind of shocking right here. These hurt. These were painful, but they probably unloaded them. They probably did some loans and had enough time where they just sold the loan for what they did it. So they made no money, right? It went from being worth $515,000 to being worth $500,000. If they held on too long, that thing was only worth like $480 up here. So they actually lost money on that loan. And why that's a big deal is because they actually have to credit back the $500,000 that they were lent by their lender, and then they had to basically come up with another $15,000 in this scenario. So it's a constant, give and pull. But in general, the mortgage market only has quarter point moves and things of that sort. So they're just always usually varying between making 3% on a loan, or making 2%, or making 4% on a loan. Usually the movement is very small. But with this here, street value rates going to 6% like they are now, and possibly higher this next week, this 5% loan here has a real risk of having a street value of like $440,000. If they made a 4.5 and they've been sitting on it, that loan is maybe only worth $410,000. because the new market rate is 6%. As you can see here, the 6% loan is still worth 515. So the ones that are at lower rates, when rates are going up, really decrease in value. Now, if they were able to sell a 6.5% rate, then that loan is worth 540,000. Now, here's where it gets shocking. If street value rates go up to 7%, is anybody going to want 4 or 5% loans at that point? There's already going to be a huge pipeline of 6%ers from July, and then now from mid-August and September. So, who's going to want $20,000 or $25,000 of annual income stream when you can buy one that throws off 30,000, 32,000 or something? So, what I'm showing here is even if they make a loan here at, let's say they make a loan at 6%, and then they didn't sell it when it was at 5, and so now it's at 6 again, and for whatever reason they can't get that loan packaged and sold, and rates go to 7, this loan's only worth 440,000. And so these mortgage companies that have 2,000-3,000 employees, the big name ones you see all the time, a lot of local regional ones, there is hundreds of these. There is probably a few million people employed in the mortgage business. So in a general month, they might do 2,000 loans, a single mortgage company. Let's say at an average loan amount of 500,000. That is actually $1 billion line of credit that they lend. Okay. And then they take their 3% off of that, which would be 30 million. And that's a 3% profit, like we're right here. So if rates are flat and they don't move around a lot, you make a loan, a month later, you sell it for about 3% more than what the face value of the loan was. It's to pay back for all the work, everybody who worked on that loan inside the company. Now, if we start having an issue where we've got $500,000 loans that we thought we were going to make money on, now being worth 440, 6% ones here, and then they go to 70, we run the risk of having $75,000 in losses times 2,000 loans in a month. This starts getting massive. This is a $150 million loss for a company that maybe has 2,000-3,000 employees. I don't know about you, but I don't think most companies can afford to lose $50,000 a month per employee. And where in a normal scenario, they would have made 3% on each one of those. So they would have made 15,000 times 2,000 loans. And that is a $30 million gain to pay 3,000 employees. So, that works out, what is that, $10,000 a month income generation, which is about right. A lot of people get paid $4,000, $5,000, $6,000, $7,000 a month in the business, and then you have overhead. So this is what I'm talking about. This last move is going to be killer. You are going to have companies that are literally sustaining 100, 150 million, maybe $200 million losses. And I know we hear all these crazy terms now, billions and trillions, that the government is just printing and throwing around. But real companies actually work off of numbers mostly in the millions on a monthly basis. Maybe, a good company has a few billion in revenue in a year. But most companies are in the millions. And this kind of loss would take 5 months just to get back even. So not even to pay. I think you're going to see this is going to be devastating. That's all I can say. This is not something you can come back from. This would be like having, let's just choose a burger restaurant, right? And the burger restaurant has 20 employees, and the burger restaurant normally makes 100,000 a month, right? Revenue that it brings in. And this would be the equivalent of, so you got 20 employees, you got to pay, let's just pretend there's no overhead, 5,000 a month. That's 100,000 in a month. Can you imagine if a burger joint, small burger joint, just 20 employees, so you only have 5, 6 employees at a time. It would be like you taking a $500,000 hit one month. How are you going to come back from that with 20 employees, and you owe them 100,000 a month, in payroll? You're not. You're. There's going to be some that just straight up shut their doors. Others may lay off half. I think that's what we'll start seeing. It's going to be some serious, because they're going to have to cut into this normal gain. They know they're not going to get it back right away. They're going to have to make payments on this. Their lines of credit may be slashed in half. Probably that'll happen. I can imagine if you lent $1 billion to a company, and the following month they said, we only pay back 850 million. Sorry about the other 150. Are you going to turn right around and lend them $1 billion the next month? Most likely not. Maybe the 850 and say, well, let's roll with it. So that right there is a 15% reduction. But most likely, you're going to cut their line of credit. So you're going to see less lending, less borrowing, and this is a shocking chart. In fact, I'll show you how shocking this chart is. Let's just go to a 5-year chart. I mean, and this here is a shocking chart, having rates go from 5% in 2018 down to 3% in 2020. So that's a 2% move over 2 years on the downward scale. And this is huge, and I'll show you why this is even a huge move. So when you take a move that is almost twice that size, from right here, 2.5 range and stuff, to 6 in 1 year, that is a multitude greater of a move. And now this move, they were all making money because they were closing loans, and the next month the loan was worth more on the street. Worth more, always worth more. And down here is bouncing around. So let's just do this. You'll see how dramatic. So look at this. Over the last 10 years, if you take out this dip down here when they got super low, I'm showing a 30-year fixed rate mortgage chart for 10 years. For 10 years, they were between, let's just call it 3.5 and 4.5 was the high there. 5. So the range for 8 years was 3.5 to 5%. 8 years, it stayed within this range, a 1.5% range. Well, we just got down into the mid 2s, and we are now in the 6s. We in a year. So going from a 1.5% range to a 3.5, almost 4% range in 1 year, this is big problems. Big problems. I'm going to make a few other videos talking more about the rates, and I'm going to show you why a few months ago when interest rates did that pop, I said when Powell made the statement in here, late fall, I said we're going to see 6% mortgage rates by the end of the year. I thought I was making a bold call, but here we are in September. We didn't even have to wait till the end of the year. It's very likely we're going to be at 7 before the end of the year. I'll show how mortgage rates work. It's not the way they'll tell you on TV and in media, and I'll show you how you yourself can track where mortgage rates will go and why I knew that they were going to go much higher. Even though when they were in here, people thought they were going to stay at 4, 4.5. They just couldn't fathom the 6s. Now a lot of people are saying, yeah, we kind of knew it. We saw it. No, they didn't. Nobody was talking back here. When I brought up in some corporate meetings that we were going to be seeing 5.5, 6% after this move right here, everybody thought I was crazy because they had been experiencing 3 and 2% for 2 years. So no, people did not see this coming. All right, guys, thanks so much. If you need to get a loan, if you're going to need one in the next year or two, borrow it now because it's going to be easier now and less interest now. Even if you don't believe me, think about it. You could get it now, and if you think I'm going to be wrong, great. In a year or two, then you refi back at 4 or 5 because you think I'm just a crazy person, or pay the loan off. But I'm telling you, you'll be glad that you borrowed at these rates. I just locked a bunch of people in around 5. They're very happy because now they know that rates would be 6. All right, thanks, and make it a great day.